Good afternoon, I'm Cynthia. I'm here with Doug, and we'll help you make money in the stock market with information you will not find anywhere else, because we are Wall Street Media.
Oh, look at that. We're getting so good at it.
We're getting so good at that. So let's get straight down to business.
Okay.
We've got Rich Gordon, fixed income market strategist of Wachovia, WB, discussing the deflationary pressures and distressed economic numbers that will continue through 2009.
We love Rich Gordon. Let's take a look.
Let's take a look at the clip. Go to the clip, Mike.
Last week, major U.S. stock indexes rallied over 10% in a holiday-shortened week with relatively light trading volumes. After the catastrophic losses to financial asset values of all types throughout 2008, it would certainly be nice to see a rally in risk assets heading into the new year. But on balance, it doesn't appear that the fundamental underpinnings are in place for a V-shaped rally in equities in the near term. Instead, Monday morning, the markets opened weak and traded off throughout the day, keeping the downward trend in place. I think the best that equity investors can hope for over the next month is to tread water and end the year without reaching new lows. Here are a few reasons. First, the U.S. economy is weak. The ISM reading on Monday in the 30s is consistent with a meaningful downturn. The payrolls number on Friday should provide further confirmation of the severity of the economic slowdown. Wachovia's economics group is expecting further jobs losses of 350,000 for November. Second, deflationary pressures. The 10-year Treasury yield has dropped relentlessly over the past 3 weeks, and it's now around 2 3/4. Some people think this rally is very overdone, which is supported by the RSI reading below 28. However, it's also possible that the collapse in government yields is a rational decision by investors to extend duration in the Treasury market, positioning their portfolios for an extended deflationary environment. I'm not there yet. I don't think the U.S. will see an extended period of severe deflation similar to what Japan had in the 1990s. The primary reason is that the U.S. government initiated substantial monetary and fiscal stimulus measures fairly early in the downturn, while Japan's stimulus took them years to implement. However, there's no denying that the forced deleveraging that's occurring across nearly every financial market is putting substantial pressures on asset values of all types, and unfortunately, the outlook for 2009 isn't much better than 2008. So while long treasuries might be short-term overbought, the basic trend towards lower long-term government bond yields should hold. As long as there's a reasonable likelihood of further deflationary pressures in financial asset prices, it seems unlikely that equities can really get much upward traction. In the funding markets, the next Fed meeting is in mid-December, and futures are pricing in a 100% chance of a 50 basis point cut and even a 40% chance of a 75 basis point cut. While they might cut rates further, I think the Fed would see diminishing returns for more cuts for several reasons. First, it would create difficulties for money market funds. Very low short-term rates make life tricky for money managers whose revenue streams are tied to asset yields and 12b-1 fees. If the Fed lowers the target rate to 50 basis points, money market mutual fund yields could drop close to zero after fees. While this probably won't force large money fund complexes to close their doors, it could have an impact on smaller funds that don't have parental support and the economies of scale to forego fees for an extended period of time. This could end up disrupting liquidity in the money market sector. Second, further rate cuts could impair liquidity in the Treasury market. Treasury delivery failures have been falling since they spiked in mid-October, but they're still high, and they'd probably rise again after additional cuts in the funds rate. A failure occurs when a trade is confirmed and the seller then fails to deliver the bonds as agreed. Failures increase as the relative value for the securities in the repo markets rise, which pressures the financing rate for the securities lower. What happens is that the holders of the bonds can decide to repo their securities instead of delivering them. So additional rate cuts could actually have a detrimental effect on liquidity in the Treasury market, certainly not the Fed's intent. Turning to structured products, nearly 1.5 years after the start of the credit crisis, it's hard to overstate how horribly broken the structured products markets still are. The best way to illustrate the severity of the dysfunction is to walk through a hypothetical deal structure in the CMBS market at current market prices on the securities. 70% of the deal is AAA Super Senior, priced at LIBOR plus 1,300 basis points, which is now 16%. 15% of the deal is Junior AAA, priced at LIBOR plus 3,000, a yield of 33%. The rest of it, the mezzanine and equity pieces, price at LIBOR plus 4,500, or about 48%. On a blended basis, the all-in cost of the liabilities in the deal would be over 23%. This implies that the yield on the underlying mortgage loans would have to be even higher than that. Obviously, the ARB became undone months ago, and as a result, there's been almost no new issuance in this or many other structured credit markets that have been similarly repriced. Maybe the most disturbing aspect to this analysis is that even though it's not necessarily fair to apply these deeply distressed bond prices to the prices of the underlying commercial real estate loans, it should be clear that the underlying loans obviously have a diminished value, and few held-to-maturity balance sheets have acknowledged that the mark-to-market prices on their commercial loans are a lot lower now than they were when the loans were made. It also highlights the huge challenge the government has to restoring a reasonable flow of credit in the commercial mortgage markets.
And we're back.
Hey, I love Rich Gordon, man.
I love Rich
Super
Gordon.
smart guy, wonderful, ethical guy. He's not very bullish on stocks for 2009, however, though.
No.
But do you know where you should go to get bullish ideas on stocks or a place to make money in stocks?
StockTwits.
Yes, you should.
And where else should you go if you want to look up a term?
In Investopedia.
Yeah, and what if you want to follow people that are doing very well or not doing so well, or just follow people
This is
and
like
learn?
a test.
Where would you like
Luckily,
to go?
I have a cheat sheet. Covester.
Very good.
Hey guys, listen to
They're
Rich
like the Three
Gordon.
Musketeers. You got Covester, Investopedia, and StockTwits. Those are our Three Musketeers of the year.
That's right. Awesome. Fantastic, man. It doesn't get any better than that. You've got Cynthia, Rich Gordon, Covester, StockTwits, and Investopedia.
Thanks for joining us. We'll see you again soon. You can find us every day at WSNCO.com. Say goodbye, Doug.
Thank you, Cynthia.